Working out your affordability is one of the first things every first-time buyer should do when you're thinking about buying your first home. However, there are lots of different variables which can affect your borrowing potential. In this video, I go deeper into the process, which will give you a better idea of your borrowing potential. Let's go. What's up, Alex Kerr from Mortgage Chain, and I'm a qualified mortgage broker, and on this channel we provide the best tools and tips to first-time buyers. If we are meeting for the first time, please consider subscribing. Let's jump into the video. First of all, your income can have an effect on how much you can borrow. Some lenders will cap the income multiples or affordability maximum amount you can borrow if your income is low, where others, for example, a lender that I currently work with, if your income is over 50,000, they'll give you 5.5 times your income. Where I know another lender will cap your income around 3 times if your income's low, and by that they mean below 15,000. Having debts and credit commitments can affect the amount you can borrow. For example, if you had a loan which was £100 a month, you times that by 1,200, the lender will deduct that from your income before they work out how much you can borrow, therefore resulting in a lower borrowing amount. So the lower the debts you have, the more you can borrow. Deposits. The amount you deposit can have an effect on the amount you can borrow. Generally speaking, the more deposit you have, the less risk you are to the lender, therefore the more you can borrow. Credit score. Some lenders have different tiered scoring systems. The better your credit score, the more they will lend. So trying to keep your credit score the best you can sometimes enable you to borrow more. Some lenders specialise in providing mortgages dependent on your profession. For example, teachers, barristers and chartered accountants and similar professions can sometimes borrow up to 6 times with specialist lenders. So dependent on your scenario and your situation, lenders could potentially lend anywhere between 3 to 6 times your income. However, a really good calculation to use, which will be fairly accurate, irrelevant of your situation, is just to times your income by 4.5 once you've deducted any credit commitments. Please see the comment section below for the calculation. Finally, some lenders are happier to lend you a higher loan amount if you choose a 5-year fixed rate as a product. That means for 5 years, your monthly payments are going to stay exactly the same, the rate's going to stay the same, and therefore the lender's prepared to lend a little bit more because you're less risk and less vulnerable to any rate increases or monthly payment increases early on in your mortgage. Today's question, are you trying to work out your affordability? Let me know in the comments. So thanks for checking out today's video. Please do check out the show notes for a recap on today's content. And if you're new to the channel, please consider subscribing or ringing the bell. Till next time, have a beautiful day. We'll see you in the next video.